So earlier this year, COMEX had 103 million ounces of registered silver sitting against 429 million ounces worth of paper contracts. That's a 4-to-1 ratio. Since then, the registered inventory has kept dropping, and paper leverage is now sitting at a 7-to-1 ratio. 7 ounces of paper promises for every 1 ounce of real silver. And in March alone, delivery demand hit 52 million ounces. So yeah, let's talk about what this really means. Before anything else, the pullback that we've seen in the silver market makes total sense. It was going up 70 to 75% in just the first 2 months of this year, and gold was hitting all-time highs every other week, it seemed. That kind of move just doesn't keep going in a straight line forever. A correction was coming regardless of the war in Iran or the Fed or anything else. That's just how the market works. But here's the thing, when everything corrects and people are focused on the price chart going down, that's usually when the more important story is happening underneath. And right now, what's happening underneath the silver price is generally one of the most interesting supply situations I've seen in a long time. So let me show you what I mean by it. And really quick, if you're finding this useful, hit the subscribe button, drop a like, it generally helps and keeps me motivated to keep making these videos. Okay, so the COMEX has two types of silver. Registered silver, that's the metal available right now for actual physical delivery, and eligible silver. That's metal sitting in their warehouses but has not been cleared for delivery yet. When people talk about the COMEX running out of silver, they're talking about the registered number. And that number dropped 38% in just 3 months, from 167 million ounces in October of 2025 down to 103 million ounces by February. That's not a slow bleed, that's a drain. And in just 1 week in January alone, 33 million ounces got physically pulled out of COMEX warehouses. 33 million ounces in 7 days. That's nuts. That's 26% of the entire registered inventory gone in a single week. So when delivered demand starts pushing against what they actually have physically, they basically have two choices. They deliver the silver or they cash settle, meaning that they just pay people dollars instead of handing over the silver. And that's why the second option is such a big deal. The second the COMEX starts regularly cash settling instead of delivering real silver, their price isn't the silver price anymore. It's just the price of a financial promise, and those are two completely different things. There's an analyst called Bill Holter who's been covering this for a while, and he put it pretty simply. If COMEX can't deliver, the contract is worthless. Zero. I'm not saying that's definitely where things will end up, but the math is uncomfortable enough that you'd be crazy not to pay attention to it. And here's what makes this even more interesting. India and China are already moving away from the COMEX and the London Metals Exchange as their price reference. They're telling traders to use local prices, Shanghai, Hong Kong, and their own exchanges. That's a massive shift. For decades, the COMEX and the London Metal Exchange basically set the global silver price. If the biggest buyers in the world stop using those prices as their benchmarks, those exchanges lose their whole reason for even existing. China specifically is buying silver right now, not as a monetary play, but they need it for their EVs, solar panels, and electrical manufacturing. This is the industrial demand, and they're going directly to the miners and producers, bypassing the paper market completely. Samsung went directly to the silver miner, paid cash to restart the whole mine, and lock in 2 full years of production before a single ounce came out of the ground. That metal's gone from the open market permanently. These companies aren't watching the COMEX charts, they're going straight to the source. Outside of silver, the broader market is pretty fragile in certain pockets. Tech is getting hit, private credit and private equity are getting hammered. BlackRock actually froze withdrawals on one of their private credit funds recently, which is a huge deal. Those strategies were never built to let investors pull out money on demand. When people want their cash and the fund literally can't liquidate fast enough, that's where things get messy. The big banks, though, JP Morgan and the rest, barely moved. And the reason is pretty actually straightforward. All the money fleeing private credit has to go somewhere and is going back into public market stocks. So weirdly, the sell-off in private assets is actually helping parts of the public market right now. Whether that holds is a completely different question. Okay, so the national debt is 39 trillion as of right now, up from 38 trillion 5 months ago. $1 trillion every 5 months, and we're not even in a recession officially. That's just the baseline spending that nobody in Washington wants to deal with. On top of that, there's economists out there that are saying that the real number, when you factor in everything that the government has already promised but hasn't funded yet, is closer to 100 trillion. not the 39 trillion that we see on the screen, but 100 trillion. That's the actual tab that we owe. So what do they do with it? They're not going to default. They're not raising taxes enough to cover it. What they're going to do is what they've always done: print money. The Treasury Secretary can say we're nowhere near quantitative easing all he wants, but the math doesn't care what he says. At some point, the Fed has to buy this debt, and when that happens, every dollar sitting in your bank account buys less. That's just how inflation works. So, where does all this leave me personally? I'm not sitting here saying put everything into silver and ignore everything else. You still need income and money to pay for the bills, and you need to be able to sustain the downside. Diversification matters, but my core, the foundation under everything, is the physical metals. And right now, with the paper price under pressure, I've been continuing to add to my stack. Because when I look at the full picture, paper leverages 7 to 1. Asia's building its own pricing system right away from the West. China is locking down silver exports through strict licensing systems that went in effect on New Year's, January 1st. Registered COMEX inventories are down 38% in the last 3 months, and a $39 trillion in debt with QE coming, whether anyone admits it or not. And then the silver miners pricing in their own future production at $122 an ounce, not 68, 122. The guys who actually dig the stuff out of the ground aren't panicking. They're not pricing it at 68. They know what's coming. The paper price is whatever it is today. The physical story underneath is completely different, and that's the only thing I care about. So if the COMEX sitting at a 4 to 1 paper to physical, Asia building its own pricing system, and a 39 trillion in debt and more printing on the way, private credit is starting to crack. Silver miners are pricing metals at 122 an ounce, and that's where we're at right now. So drop your thoughts in the comments. Are you adding to your stack right now, or are you waiting for another dip? Hit subscribe, and I'll see you on the next one.